Most people think dividend investing is safe. Buy a few high-yield ETFs. Collect passive income. Retire peacefully. Sounds smart, right? Not exactly. Because a lot of dividend ETFs are quietly designed to make you feel secure, while slowly destroying your future purchasing power. Some pay big dividends because the underlying companies are weak. Some look stable until the market changes. And some are basically traps disguised as income. Meanwhile, a small group of dividend ETFs keep doing something different. They survive recessions. They compound through uncertainty, and they continue paying investors even when the economy gets ugly. That's the difference between income and financial durability. So in this video, we're breaking down 10 dividend ETFs that actually deliver long-term security. Not hype, not temporary yield spikes, not TikTok investing. We're talking about ETFs built to survive decades. And by the end, you'll understand something most investors never realize. The goal isn't maximizing income. It's building a financial system you can still trust 20 years from now. 10. The Look Safe Trap. SCHD, Schwab US Dividend Equity ETF. This is where most serious dividend investors eventually start. And there's a reason for that. SCHD doesn't chase random high-yield companies. It filters for profitable businesses with strong cash flow, healthy balance sheets, and a history of paying dividends consistently. That matters more than people think. Because high dividends alone mean nothing. A company can pay an 8% yield right before collapsing. We've seen it happen. Banks, telecom companies, commercial real estate. Entire sectors looked safe until they weren't. SCHD avoids a lot of that behavior by focusing on quality first. And psychologically that's important, because many investors are secretly searching for emotional relief, not financial performance. They want income because income feels predictable. But predictable cash flow from weak businesses is still weak. That's where people go wrong. They confuse yield with security. Big difference. Now here's why SCHD became so popular during uncertain markets. Its holdings are usually mature companies with durable earnings. Companies people still use during recessions. Pepsi, Coca-Cola, Home Depot, Broadcom. Not speculative stories, real cash-generating businesses. And that creates something powerful. Consistency. Not excitement, not dopamine. Consistency, which sounds boring until the market crashes. Then suddenly boring becomes priceless. But here's the problem. Even SCHD has limitations. It's heavily tilted toward value and mature businesses, which means during aggressive tech rallies, it can lag badly. And that introduces the first major lesson of this video. Long-term security is not the same as short-term outperformance. Most investors can't handle that emotionally. They say they want stability, but emotionally, they still compare themselves to people getting rich faster. That tension destroys portfolios. And that leads to the next ETF. Because some investors try solving that problem by adding more growth and accidentally add far more risk instead. Number 9. The False Comfort of High Yield. VM. Vanguard High Dividend Yield ETF. This ETF sounds perfect on paper. High dividend yield. Simple, clean, safe. Except high yield can become a psychological drug. Because once investors see larger payouts, they start optimizing for income instead of resilience. That's dangerous. VYM holds large established companies with above-average dividends. It's diversified, low cost, very stable compared to chasing individual dividend stocks. That's the good part. But the hidden issue is behavioral. People begin anchoring their success to monthly or quarterly income, not total wealth creation, so they stop asking better questions. Like, are these companies still growing? Will inflation destroy the real value of this income? What happens if these industries stagnate for 15 years? That's the part nobody talks about. A 4% dividend means very little if your purchasing power quietly collapses. And this becomes especially dangerous for younger investors. Because many people in their 20s and 30s are trying to build retirement-level income portfolios too early. Why? Because income feels emotionally complete. Growth feels uncertain. But security without growth eventually becomes fragility. That's the contradiction. VUM works best when paired with long-term compounding expectations, not as a replacement for growth, and mature investors understand this instinctively. The goal is not extracting maximum income today. It's building an asset base large enough that future income becomes effortless. Different mindset, which brings us to something deeper. Some ETFs don't just focus on dividends. They focus on the companies most likely to survive economic chaos itself, and that changes the entire conversation. 8. Surviving Economic Winters. DGRO, iShares Core Dividend Growth ETF. Now this is where dividend investing becomes more strategic. DGRO doesn't simply look for companies paying dividends. It prioritizes companies consistently increasing them. That sounds small. It's not. Because increasing dividends over time usually signals something underneath. Expanding cash flow, operational strength, management confidence. Weak businesses struggle to grow payouts consistently. Strong businesses can. That's why dividend growth matters more than raw yield over long periods. And psychologically, this ETF rewards patience instead of urgency. Most investors are conditioned to chase immediate results, immediate income, immediate gains, immediate validation. But wealth rarely compounds that way. Real wealth compounds quietly, at first almost invisibly. Then suddenly, DGRO is built around that philosophy. Many of its holdings are companies steadily growing profits year after year. Not explosive, not viral, durable. And durability is massively underrated because it's emotionally boring. People underestimate slow compounding because humans are wired for visible progress. That's why investors constantly interrupt their own success. They switch strategies too early, sell during volatility, chase trends, abandon systems, then wonder why wealth never stabilizes. DGRO quietly solves part of that problem. It creates a portfolio structure where time becomes an ally instead of an enemy. But now we hit another issue. Even high-quality dividend ETFs still rely heavily on the U.S. economy, and many investors think geographic diversification automatically solves risk. Not always, because international exposure introduces a completely different set of problems. RE7, the Global Diversification Illusion. VG, Vanguard International Dividend Appreciation ETF. This ETF sounds intelligent immediately. International dividend growth, global exposure, currency diversification, reduced dependence on the U.S. And on paper that makes sense. But international investing tests something deeper. Patience without familiarity. Most investors say they want diversification until international markets underperform for years. Then suddenly they panic because emotionally people trust what feels familiar. American brands, American markets, American news cycles. VG expands beyond that. It focuses on non-U.S. companies with histories of growing dividends consistently. That's important because many international markets operate differently than American growth culture. More conservative balance sheets, different payout structures, different economic cycles, and that can strengthen portfolio resilience over decades. But here's the catch. International dividend growth is usually slower, less explosive, less exciting, and that's exactly why many investors abandon it too early. They don't lose faith logically. They lose faith emotionally. That distinction matters, because long-term investing is rarely a knowledge problem. It's usually a behavioral endurance problem. Can you continue following a strategy while feeling temporarily behind? Most people can't. That's why security becomes rare. Not because the strategy is unavailable. Because consistency is psychologically difficult. And now we arrive at one of the biggest misconceptions in dividend investing. The belief that safe automatically means low volatility. It doesn't. Not even close. RIU, the stability misunderstanding. STV, iShares Core, High Dividend ETF. This ETF leans heavily into established defensive sectors. Healthcare, energy, consumer staples, the kind of companies people assume will always survive. And many probably will. But investors misunderstand what stability actually looks like. They think stable means prices don't move. Wrong. Stable means the underlying businesses continue functioning even when fear spreads everywhere. That's different. A stock can fall 25% and still remain fundamentally strong. Most people emotionally cannot separate price movement from actual risk. So when markets panic, they panic too. HDV attempts to anchor around financially durable companies. But the deeper lesson is this. Emotional stability matters just as much as portfolio stability. Because if your strategy causes you to panic during downturns, the strategy is broken for you, not mathematically, psychologically. This is why some investors fail even with good ETFs. They choose systems incompatible with their emotional tolerance. Then volatility exposes them. And here's where things become uncomfortable. A lot of investors don't actually want wealth. They want relief. Relief from uncertainty. Relief from work stress. Relief from financial anxiety. That emotional pressure causes bad decisions, like chasing yield during recessions, or abandoning compounding during crashes, which brings us to the midpoint. Because this isn't really about ETFs anymore. It's about the mindset underneath them. You thought this was about money. It's not. It's about how you think about security. Most people don't invest for freedom. They invest to reduce fear. That changes everything. Because fear-based investing creates fragile behavior. You chase certainty. You avoid volatility completely. You prioritize comfort over durability. And ironically, that often creates more long-term risk. The investors who survive decades understand something different. Security is not the absence of uncertainty. It's the ability to remain functional during uncertainty. That's the real game. And the next ETFs reveal who actually understands that. 5. The quiet power of dividend aristocrats. NOBL, ProShares S&P 500 Dividend Aristocrats ETF. This ETF only holds companies that increase dividends for at least 25 consecutive years. Think about that for a second. These companies survived dot-com crashes, financial crises, inflation spikes, pandemics, rate hikes, and still continued paying shareholders more. That consistency tells you something profound, not about stock prices, about institutional resilience. Businesses capable of raising payouts for decades usually have operational discipline most companies never develop, and that matters during economic stress. Because chaos exposes weak systems fast, Noble is less about maximizing gains and more about identifying corporate endurance. But there's another psychological layer here. Most people dramatically underestimate how rare consistency actually is. In fitness, in business, in investing, everyone talks about intensity. Very few survive long enough to benefit from consistency. Dividend aristocrats reward endurance, not brilliance. And that's incredibly important for conservative investors, because sustainable wealth rarely comes from heroic decisions. It usually comes from avoiding catastrophic ones. Now here's where investors often make another mistake. They start becoming too defensive, too conservative, too obsessed with preserving money, and eventually, they stop allowing their wealth to grow at all. 4. The inflation reality. DGRW, Wisdom Tree U.S. Quality Dividend Growth Fund. Inflation changes the entire dividend conversation, because a portfolio that feels safe can quietly become weaker every year. That's the hidden danger. Especially in high-income strategies with low growth, DGRW tries solving that by focusing on companies with both dividend growth and earnings growth potential. That combination matters enormously, because real security requires adaptation, not just preservation. Think about the world 20 years ago. Different technologies, different industries, different winners. The companies surviving the next 20 years won't just be stable. They'll be adaptable. DGRW leans into that idea. And psychologically, adaptability is one of the hardest things for investors to maintain. People become emotionally attached to old narratives, old industries, old assumptions, old market environments. Then the world changes, and their portfolio doesn't. That's dangerous, because long-term investing is partially a bet on future relevance, not just present income. This is why intelligent dividend investing is not passive laziness. It's selective patience. Big difference. And now we move into ETFs built for people thinking even longer term. Not quarterly, not yearly, decades. 3. The compounding machine. VIG, Vanguard Dividend Appreciation ETF. This ETF is one of the cleanest long-term compounding tools available. Not because it has the highest yield. It doesn't. That's exactly the point. VIG focuses heavily on companies consistently growing dividends over time rather than paying massive current income. And that changes investor behavior dramatically. High-yield portfolios tempt people into consumption thinking. How much cash flow can I extract? Dividend growth portfolios encourage ownership thinking. How strong can this asset become over decades? Completely different mindset, and mindset eventually shapes outcomes. VIG works because it aligns with economic reality. The strongest businesses usually reinvest intelligently, expand gradually, and increase shareholder payouts sustainably over time, not explosively. Sustainably, that word matters, because sustainable systems survive stress. Unsustainable systems eventually break. And this applies far beyond investing, careers, spending habits, lifestyle inflation, debt. Many people look financially successful while operating unsustainable systems underneath. Then one disruption destroys everything. Job loss, health issue, market crash, recession. Suddenly the illusion collapses. That's why long-term security is really about reducing fragility. And the next ETF takes that idea even further. Number 2, the Total Return Awakening. SPYD, SPDR Portfolio, S&P 500 High Dividend ETF. Now this ETF is controversial. Some investors love it. Others hate it. Why? Because SPYD aggressively targets higher dividend-paying companies within the S&P 500, which means the yield can look extremely attractive, especially during uncertain markets. But here's the dangerous psychological trap. High yield creates the illusion of progress. Investors see income flowing in and assume the strategy is working. Meanwhile, underlying growth may be weakening. That's why total return matters, not just dividend payments. And this is one of the biggest shifts serious investors eventually experience. At first, they focus on income. Later, they realize wealth creation depends on the interaction between income, growth, valuation, inflation, tax efficiency, behavior. Everything connects. SPYD can work very well in specific environments. but only if investors understand what they actually own, not emotionally, structurally, and most people never reach that stage. They buy investments based on surface-level narratives. Safe, passive income, monthly cash flow. But wealth is more nuanced than slogans, which brings us to the final ETF. And this one represents something deeper than dividends alone. It represents financial endurance itself. 1. The ETF built for financial survival. JEPI, JP Morgan Equity, Premium Income ETF. This ETF exploded in popularity for one reason. People are terrified of instability, economic uncertainty, layoffs, inflation, volatility. JEPI promises something emotionally powerful. Income with reduced volatility. That's why investors rushed into it, especially older investors and people exhausted by market swings. JEPI uses covered call strategies to generate additional income while holding large cap stocks underneath. And during unstable markets, that can feel incredibly comforting. But this is where sophisticated investors think differently. They don't ask, how much income does this produce? They ask, what trade-offs am I accepting? Because every strategy has one. JEPI may reduce upside during powerful bull markets. That's the cost of smoother income. And understanding trade-offs is one of the biggest differences between emotional investing and strategic investing. Emotion wants certainty. Strategy understands compromise. That's the final realization. No ETF eliminates risk. No dividend guarantees freedom. No portfolio creates permanent certainty. But some systems are far more durable than others. And durable systems change lives. Because eventually investing stops being about outperforming strangers online. It becomes about building a life resilient enough that market chaos no longer controls your decisions. That's real security, not flashy gains, not internet bragging rights. Control. Most people spend years searching for the perfect investment, the highest yield, the safest ETF, the fastest path to passive income. But the deeper truth is simpler than that. Your portfolio only works if you can psychologically survive holding it. That's the hidden game, because wealth is not destroyed by lack of information. It's destroyed by panic, impatience, fragility, and the constant need to feel certain. The investors who eventually build real freedom usually do something different. They stop chasing emotional relief and start building durable systems instead. But dividend ETFs are only one piece of that puzzle, because some investors still fail financially, even while owning good assets. Why? Because the biggest mistakes happen outside the portfolio, and that's what the next video is about. Top 10 mistakes keeping ambitious investors from early freedom. Because this isn't the biggest trap. The next one is worse.